Hi, this is Ashish Shanker and I'm happy to present to you the latest edition of our Alpha Strategist titled Ballot, Bullet and Bazaar. Just to give you a little bit of a global backdrop, we've seen that central banks in the US as well as Europe are messaging for benign interest rates going forward. Both these central banks are concerned that economic growth is slowing down, and as a result, if you see what Fed is messaged, they have messaged that they may probably not hike rates, and even if required, they will put in more liquidity in the system if they see growth faltering further. Similar kind of messaging we've seen from ECB as well, and China also seems to be struggling with its own growth. So in China as well, the central bank is trying to pump in more liquidity and stimulate the economy. Now, all of this is pretty good for countries like India and emerging markets. Reason being that whenever global liquidity is a little loose, you see flows accelerating to emerging markets part of the world because of the interest rate arbitrage, as well as equities, they start doing well. Now, in India, we were recently witness to the border tensions escalating. However, we saw that a lot of it is already abated, and now people will look forward to the elections where the results are slated to be declared on May 23rd. There is a lot of print as well as there is a lot of discussions which you will see around elections and whether the ruling party will come back to power, whether it will be a coalition government, so on and so forth. However, as we've always messaged that in the near term, the markets tend to react basis sentiment around all of this news flow. In the longer run, the markets basically follow earnings. They are a slave of earnings. So I thought, let me try and present to you what our fundamental view is on earnings as well as the economy going forward over the next couple of years, since we strongly believe that this will drive returns in portfolios going forward. If you look at the quarter gone by, we saw at an aggregate level, Nifty profit growth was close to 6%, whereas sales growth was close to 22%. However, this masks the underlying strength across many segments of the economy. If you look at what is happening, bulk of this profit growth was dragged down by oil companies, where you see inventory gains and losses again playing into quarterly earnings. You also saw that corporate banks took a lot of provisioning, especially banks like SBI, ICICI, Axis, which have large corporate bank balance sheet. They've been continuously provisioning. The good news or the silver lining is that we've seen that provisions have reached close to 70% in a lot of these cases, and incremental slippages have reduced dramatically. So this pack of banks itself will drive incremental profit growth of 8% next year. So we are reasonably confident that profit growth of 15 to 18% will be achievable, and the visibility is the strongest that we've seen over the last couple of years. As far as fixed income is concerned, we saw the entire ILFS saga playing down, and as a result, yields spiking up. Even today, we see yields at elevated levels. AAA bond yields are still closer to 8.5. In fact, credit portfolio yields are even more attractive. They are closer to 9-10%, and the NBFC liquidity tightness is still not, the story is still not over. However, we see a lot of that tension getting relieved in the markets. We are seeing a lot of NBFCs coming and picking up not only equity money from the private market, we are also seeing a lot of these equity raise, a lot of these NBFCs raise money in the debt markets. Our view is that this will keep getting better over the next couple of months, and we are essentially of the view that you should get invested today in AAA bond portfolios. We have recommendations as well that are there in the Alpha Strategist. Inflation at 2% and portfolio yields at close to 8%, very long time. So for bond investors, I think the times are very attractive. You should get your investments done and enjoy these high yields while they last. On the equity side, again, if I deconstruct some of the averages, let's look at the mid-cap index. I mean, you've seen mid-cap index correcting almost 20% from the peak. However, if you see the market cap of the mid-cap index, which was close to 21 lakh crores, is down to 15.5 lakh crores. You've seen the market cap correct by 30%. What does this tell you? There are few companies which have not corrected significantly, but a lot of companies which have corrected significantly. So at the index level, you've seen a correction of only 20%, but at the broad market level for the mid cap, you've seen close to a 30% correction. Similarly, if you look at the small cap index, it is corrected anywhere between 35 to 40%. Now, when you look at valuations, if you look at the PE ratios, the mid cap index is showing a PE of closer to 42 times. However, if you remove the loss-making companies, there are 10, 11 very large companies which have declared large losses. To give you an example, Punjab National Bank alone, which is part of the mid-cap index, has declared a loss of 17,000 crores trailing 12 months. So when we did some analysis and removed the loss-making companies, which are about 10 or 11 in number, the P drops to 20. In the small cap space, if you remove the 12, 13 loss-making companies, the P drops to 16 and 17 times. So what we're trying to message is that at a broad market levels, PEs may look inflated because of a few large loss-making companies, but if you remove these companies, valuations are at extremely reasonable levels. They are not at bear market levels, or they're not extremely cheap at 12 to 14 times, but we are not in a bear market. So with reasonable valuations and with visibility of earnings growth getting higher and interest rates which are going to remain benign, essentially our central bank is also messaged nothing different from the global central banks. They are saying that they're going to cut rates further. I think valuations from an equity standpoint are extremely attractive. So we are actually very, very positive. We are quite positive on equities, and we believe that you should try and invest a larger amount in equities pre-elections. Keep some firepower around elections, because there may be some volatility, and this firepower may help you average out further. So that's our view on equity and fixed income. We've continued the theme of investment charter that we are messaging, which we started messaging in January, because some of the discipline that one needs on the equity portfolios from a asset allocation point of view and from a investment point of view can be brought in by having an investment charter. So hope you enjoyed this update. Thank you very much.